Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. What happens when a company that used to build steam locomotives turns around and single handedly captures over 70% of a nuclear fast EV market? You get Tata Motors? If you've been tracking D Street lately, you know Tata Motors is dominating financial social media. Just today, they officially dropped the highly anticipated Sierra EV, starting at an aggressive 18.79 lakh rupees. And tomorrow, they're raising vehicle prices across the board to protect their massive cash flow. But with a massive corporate demerger, finally separating their commercial trucks from passenger cars, a delayed global mega merger with Europe's Iveco and the RBI playing around with interest rates. The big question is Tata Motors actually unstoppable, or is the market pricing in too much hype? Let's break down the ultimate investor playbook, product power and the legacy. To understand where Tata is going, you have to look at where they started. Founded in 1945 as Telco, they built the literal infrastructure of India. They gave us the first indigenous SUV with the original Sierra and changed mass mobility with the Indica. Fast forward to today, and they've pulled off one of the greatest corporate flips in history. By turning around Jaguar Land Rover, JLR has become an absolute luxury cash machine. Look at their sales numbers right now. They just clocked nearly 60,000 domestic passenger units in a single month, marking a massive 42% year-on-year growth. The secret weapon? SUVs. The Punch and Nexon make up a staggering 67% of everything they sell. Oh, and they just became the first brand in India to hit a historic 10,000 monthly EV sales milestone. They are eating the competition for breakfast, the financial deep dive, and the split. But let's talk money. Tata Motors is currently operating on two completely different cylinders thanks to its historic corporate demerger. On one side, you have the commercial vehicles arm, TMCV. Thanks to India's infrastructure boom, its revenue jumped 11% to 77,399 crore rupees, boasting an insane 72% return on capital employed, ROCE. On the other side, you have the passenger vehicles and EV arm, TMPV, pulling in 58,500 crore rupees. But here is the real kicker for investors. Look at the balance sheet. Tata Motors erased years of crushing legacy debt and officially turned net cash positive to the tune of 13,713 crore rupees, generating over 12,000 crore rupees in free cash flow. Valuation-wise, the market is pricing the passenger division at a reasonable 20 times PE, while the highly efficient commercial division commands a premium 41 times PE. It's clean, it's debt-free, and it's highly focused. The macro threat, RBI and the rupee, but it's not all sunshine and electric dreams. What happens if macro headwinds strike? Say, the RBI hikes the repo rate to fight inflation and the rupee depreciates at the exact same time? This creates a brutal tug-of-war. First, higher interest rates hit retail car loans and squeeze fleet truck operators, delaying purchases. Second, a weak rupee makes importing battery materials and raw commodities far more expensive, hurting domestic operating margins. But here is Tata's ultimate shield, Jaguar Land Rover. Because JLR earns its revenue in British pounds and US dollars, a depreciating rupee gives Tata a massive accounting windfall when those foreign profits are converted back to Indian rupees. Plus, since Tata is net cash positive domestically, local interest rate hikes won't cause their corporate debt costs to spiral. Talk about a natural financial hedge, the global stage and upcoming Q1 reality. And they aren't stopping at India's borders. Chairman N. Chandrasekaran just confirmed at the AGM that their massive €3.8 billion acquisition of Europe's Iveco group is on track to close by September. This is a game changer. It instantly expands their footprint into Europe and Latin America, aiming to shoot Tata into the ranks of the world's top 4 commercial vehicle manufacturers, targeting up to $40 billion in revenue. Now, a quick word of warning for the short term. D Street analysts are projecting a subdued Q1 earnings print soon because of cooling retail demand and temporary shipping pauses at JLR. Net profits could look temporarily depressed. But remember, smart money looks past one quarter of noise and focuses on the long-term structural execution. The verdict: So, what's the verdict? With premiumization driving higher margins, a dominant EV playbook, a fortress balance sheet, and a massive global truck expansion, Tata Motors has evolved from a cyclical automaker into a structural compounder. But I want to hear from you. Are you buying the post-demerger stock, or are you waiting for the Q1 earnings dip to play your move? Let me know in the comments below. Hit that subscribe button for more deep dives, and I'll see you in the next one.